$30. That is how far oil fell in less than 2 hours today. Not because of a ceasefire, not because Iran reopened the strait. It fell because one man said 4 words on a phone call with a television network, and those 4 words, "The war is complete," sent Brent crude from $114 all the way down to $88 in a single afternoon session. Tonight we are going to explain exactly what happened, whether you should believe it, and what it means for every energy position you are holding right now. Good evening, I'm James Harlow. Welcome to The Right Chapter, where we connect the world's most consequential headlines to the assets that respond to them. Tonight, the asset is oil. The headline is a presidential phone call, and the stakes could not be higher. Brent crude is currently trading at $88.43 per barrel, down 4.6% on the day. WTI, the American benchmark, is at $85.27, down 6.19%. Those numbers tell you something important, and we are going to spend the next 15 minutes making sure you understand exactly what. Let's start at the very beginning of today's story, because without the context of the last 10 days, today's price action makes almost no sense. On February 28th, the United States and Israel launched a coordinated series of military strikes on Iran. The operation, which the administration has since referred to as a campaign to eliminate Iran's nuclear threat, was swift, precise, and enormously consequential. Iran's supreme leader Ali Khamenei was killed in the opening strikes, Iran's nuclear and missile facilities sustained significant damage, and Iran's response, which was immediate, coordinated, and in many ways more devastating to the global economy than anyone in Washington had anticipated, was to effectively close the Strait of Hormuz. Now, we have talked about the Strait on this channel before, but I want to make sure every single person watching this episode understands why that single decision by Iran is the reason oil prices have done what they have done over the last 10 days. The Strait of Hormuz is a narrow waterway 21 miles wide at its tightest point, sitting between the southern coast of Iran and the UAE and Oman. Through that 21-mile corridor, every single day, roughly 20 million barrels of crude oil pass. That is approximately 1/5 of everything the entire planet consumes. Saudi Arabia's exports, Iraq's exports, the UAE, Kuwait, Qatar, all of it flows through that narrow passage into the open ocean. When Iran closed it, the world did not lose a little bit of supply. It lost the supply equivalent of turning off the faucet for 1 in every 5 barrels on the planet. In the 10 days since that closure began, the damage has compounded in ways that even seasoned energy analysts describe as unprecedented. Iraq, the second largest producer in OPEC, has seen production from its southern oil fields collapse by 70%. Those fields were producing 4.3 million barrels per day before the war. They are now producing 1.3 million, not because Iraq has been attacked, not because its wells are broken, but because the oil they are pumping has nowhere to go. Storage is full. Tankers are not moving through the strait. The oil is literally backing up with nowhere to be sent. Kuwait has done the same thing, announcing precautionary production cuts because its storage infrastructure cannot absorb any more barrels. The UAE is managing offshore production carefully for exactly the same reason. And on Monday, Saudi Arabia, the kingdom whose entire economic model depends on stable oil exports, began cutting its own output. Against that backdrop, Brent crude hit $119.50 in overnight trading on Sunday into Monday morning. That was the highest price since 2022. WTI hit $119.43. The biggest weekly gain in the history of the WTI futures contract, 35.6% in a single week. A number that has never been recorded before in the entire history of that market, going back to 1983. And gasoline at the pump in America hit $3.48 per gallon, higher than at any point during either of Donald Trump's terms in office. And then at approximately 3:30 in the afternoon Eastern Time, President Trump picked up the phone and called CBS News, and in that phone call, he said 7 words that stopped the oil market in its tracks. He said, and I'm paraphrasing here, "I think the war is very complete, pretty much." He also said he was considering taking over the Strait of Hormuz, meaning putting it under US military control to force it open for commercial traffic. And he added that ships are moving through the strait, which contradicted virtually every piece of data from every tanker tracking firm on the planet at that moment. Those remarks, particularly the suggestion that the war was nearly over, triggered an immediate and violent repricing in oil markets. Brent dropped from above $100 to $88 in 2 hours. WTI fell to $85. $30 of value evaporated from every barrel of oil in the world in the span of an afternoon. Now, here is where we need to be very careful and very precise, because the question every investor watching this is asking right now is, should I believe it? Is the war actually ending? And that is the right question, because the answer to that question determines where oil goes from here. Let me give you the honest picture. There are reasons to take Trump's comments seriously. He has a political problem. Gasoline prices up 16% in a week is a problem that lands directly on kitchen tables across America. The midterm elections are 9 months away. Trump campaigned aggressively on bringing energy costs down. An oil price at $120 is a direct contradiction of that promise, and the White House knows it. The political incentive to de-escalate is enormous. Trump also has a history of using media appearances to jawbone markets, to say things that move prices in a direction he wants them to move, regardless of what the underlying situation actually is. But here are the reasons to be skeptical. As of this recording, the Strait of Hormuz remains effectively closed to commercial traffic. Tanker tracking firms are not showing a resumption of normal vessel flow through the waterway. The IRGC, Iran's Revolutionary Guard Corps, has not issued any statement changing its position. Iran's new supreme leader, Mojtaba Khomeini, the son of the man killed in the opening strikes, has made no public gesture toward de-escalation. The IRGC said on Sunday that Iran was prepared to sustain 6 months of intense war at the current pace, and the infrastructure damage across the Gulf, to Qatar's LNG facilities, to UAE storage hubs, to Iraqi and Kuwaiti production, does not reverse overnight, even if a ceasefire is announced tomorrow. Oil flows through the strait would not normalize for days or weeks, even after a cessation of hostilities, because you first need the insurance market to restore coverage for tankers, then you need tanker operators to feel safe enough to transit, and then you need the physical supply chain to restart. That process, even in the best case scenario, takes time. So what you have right now is a market that is simultaneously pricing in the possibility that Trump is right, and this ends soon, and hedging against the possibility that he is wrong. And this drags on for weeks or months. That is precisely why you are seeing $30 intraday swings. This market is not behaving normally, because the situation underlying it is not normal. One analyst from CIBC Private Wealth described it this way in an interview this week: "We have gone from traders with ice in their veins to traders with panic in their veins. That is the environment you are navigating right now." Let me talk about the mechanism of today's move specifically, because understanding it will help you interpret every price swing for the rest of this week. The oil market has two primary pricing layers right now. The first is the physical premium, the extra dollars per barrel the market is paying to reflect the actual supply disruption. The 20 million barrels per day that normally flow through Hormuz are not flowing. That physical reality has a value, and the market is pricing it in. The second layer is the political premium, the extra uncertainty that comes from not knowing how long this lasts, whether it escalates further, and what Trump does next. When Trump made his comments today, he did not change the physical reality. Tankers are still not moving through the strait, but he compressed the political premium dramatically, because if the war is pretty much over, the duration of the disruption is shorter, and therefore the total supply loss is smaller. That is the key insight I want you to take away from today's session. The physical problem has not been solved. What moved today was the market's assessment of how long the physical problem will last. And if Trump is wrong, if this war continues into a third week with no meaningful de-escalation, that political premium comes back into the price fast. The $30 that came out of oil today could go back in tomorrow morning if the overnight news cycle brings fresh escalation, fresh tanker attacks, or fresh statements from Iranian leadership. Now, let's talk price levels, because that is where this channel earns its purpose. As of close of trading today, Brent is at $88.43. WTI is at $85.27. The first level I want you to watch is $90 on Brent. That is the new line in the sand psychologically. If we close above $90 for 2 or 3 consecutive sessions, it tells you the market has rejected Trump's optimism and is pricing in a prolonged disruption. If we hold below 90, it tells you traders believe the de-escalation narrative has legs, Watch that level like a hawk for the next 48 hours. The second level is $100. We crossed above it in Sunday's overnight session for the first time since 2022. The fact that we are now back below it is significant. It is the market's way of saying the $100 scenario is not yet the base case. But Rystad Energy's analysis puts Brent above $110 if current conditions persist for 2 months, and at $135 if this drags on for 4 months. Kepler's lead crude analyst has said $150 is possible by end of March if the strait remains closed. These are not fringe scenarios. They are Goldman Sachs scenarios, JP Morgan scenarios, Macquarie scenarios. The $100 level is the threshold between manageable disruption and global economic crisis. Keep it in your mind at all times this week. The third level is $80 on the downside. If Brent breaks and sustains below $80, it tells you the market believes the strait will reopen imminently and supply will normalize quickly. Below 80, the focus shifts back to the fundamental supply-demand picture that existed before the war, which was actually a well-supplied market with inventories still building. In that scenario, the oil story becomes much less dramatic very quickly. We are currently $8 above that level. The distance between where we are and where this story changes completely is $8 per barrel. Now let's talk about what the institutional players, the ones who move markets rather than react to them, are actually doing right now. The picture is more nuanced than the headlines suggest. On the one hand, the USO, the largest oil ETF, saw extraordinary volume spikes this week as institutional money rushed in on the long side. Open interest in crude oil futures contracts expanded rapidly as hedge funds and commodity trading advisors built long positions to capture the upside from supply disruption. That money was already in the market before Trump's comments today, which is why the sell-off was so violent. Those funds were forced to reduce positions quickly when the political premium collapsed. On the other hand, look at what the futures curve is telling you. Brent contracts for delivery in May 2026 are at around $110. June contracts are in the low hundreds. But by the time you get to 2027 delivery contracts, you are looking at prices in the high 60s. The market, through the shape of that curve, is essentially saying, yes, there is a severe supply problem right now, and yes, prices are high right now, but the world believes this resolves within a matter of months, not years. That is the sophisticated consensus view, and it matters because it tells you this is being treated as a crisis with an endpoint, not a structural shift in the long-term oil price. The G7 energy ministers are holding a virtual meeting tomorrow morning, Tuesday, March 10th, to discuss a coordinated release of strategic petroleum reserves. This is the same mechanism that was deployed during the Russia-Ukraine supply shock in 2022, when the United States, Europe, Japan, and other major economies released emergency stocks simultaneously to flood the market with supply. If the G7 announces a large coordinated release, analysts estimate 1 million barrels per day sustained over 2 to 3 months would be the minimum meaningful intervention. You will see immediate downward pressure on prices, possibly back toward the $75 to $80 range on Brent. The critical word here is coordinated. A unilateral US release of its own strategic petroleum reserve would be far less impactful, partly because the SPR was significantly depleted during the 2022 intervention and has only been partially refilled since. The other thing to watch is the tanker insurance market. This is the most important signal that most investors never track. The moment major marine war risk insurers Guard, Skuld, North Standard, the London P&I Club begin to reissue coverage for vessels in the Persian Gulf region, it will tell you that commercial operators believe the physical security situation has improved enough to resume transits. That insurance signal will precede any formal political announcement of de-escalation. Watch it. Here is your single most important focus for tomorrow. The G7 energy ministers meeting. It begins in the European morning, which means we will likely get headlines before US markets open at 9:30 Eastern. There are two outcomes that matter. Outcome one, the G7 announces a large, specific, time-bound, coordinated reserve release, at least 1 million barrels per day for 60 to 90 days. If that happens, expect Brent to open lower, possibly testing the $80 support level. That would be a significant signal that governments have decided to fight this crisis with stockpiles rather than waiting for military resolution. Outcome 2. The G7 issues. A statement of intent, language about monitoring the situation, and standing ready to act without specifics. In that case, the market will likely read it as insufficient. And combined with any overnight escalation from Iran, we could open Tuesday's session above $90 again. Watch for the statement. Watch for the specific numbers. Vague language from finance ministers is not news. Specific barrels per day is news. I will be here tomorrow evening with the full breakdown of both the G7 decision and the overnight price action. And tomorrow we are turning our attention to gold, which has done something in this crisis that surprised almost every analyst on Wall Street, and which has enormous implications for anyone in this audience who holds precious metals. Do not miss that episode. Oil, $88 today after touching 119, the most violent intraday swing this market has seen in years. One presidential phone call moved $30 of value in 2 hours. That is the world we are trading in right now, where a single sentence from the Oval Office rewrites the energy picture for the entire planet. Understanding that dynamic, staying calm inside it, and knowing which signals actually matter. That is the whole point of being here. I'm James Harlow. This is The Right Chapter. Subscribe, and I will see you tomorrow evening. Stay informed. Good night.